It's well known that stock and bond markets have generally gone up over time. Why else would anyone invest? Sure, there have been a few speed bumps, such as the Great Depression and the lost decade of 2000 when things didn't work out so well. But generally, investors have made money by being invested. But how do investments look when you factor in inflation? Hi, I'm Mark Armbruster with Armbruster Capital Management. In this ACM InvestED episode, we're going to discuss inflation, which is currently at a 40-year high. We'll also talk about its potential impact on your investment portfolio and how to react as an investor, or perhaps why you shouldn't overreact. Looking back over the past 100 years, U.S. inflation has averaged less than 3% annually. During that same time, the average compound returns of stocks were almost 10.5%, and bonds contributed about 5.1%. Clearly, over time, inflation has been no match for the compounding of good investments. The problem is that this is true over time, but not all the time. If we subtract inflation from the stock and bond returns to get at their real returns, it paints a much different picture. There's a 20-year period from roughly 1960 to 1980 where stocks earn no real return. That's 20 years of investment risk just to break even. And unfortunately, that was the good news. Bonds had a 45-year flat period where they earned no real return from around 1940 to 1985. Imagine saving and investing your whole life and being no better off for it after 40 years. It is possible that something similar could happen today, or maybe it's already starting. After many years of being reasonably moderate, inflation this past year jumped to 7%, its highest level in 4 decades. 4 decades! The Fed initially told us this inflation was transitory, as the economy reopened after COVID and supply chains were disrupted. However, they're no longer using that word, and the threat of persistently high inflation seems to be increasing. There are indications inflation could continue. We're all feeling the impact of rising price levels from supply chain issues that don't seem to have a quick fix. The Fed's continuation of easy money policies and the government's desire to pump more fiscal stimulus into the economy have certainly added fuel to the fire. But on the other hand, there's also reasons to hope inflation could subside. On the optimistic side, there appears to be increased fiscal responsibility from some quarters and a more hawkish tone from the Fed. But other scenarios are decidedly gloomier, such as an unprecedented $29 trillion debt overhang that threatens to curb economic growth. Just like trying to time the stock market, there's no good way to know for sure what will happen with inflation in the broader economy. In fact, there's an old joke that God created economists to make weather forecasters look good. So while inflation is a concern, it isn't a foregone conclusion that will repeat the persistent high inflation or even the stagflation of the 1970s. Still, even temporary inflation can be damaging for investors and savers. It is unlikely that consumer price increases will reverse since deflation is quite rare, so prices may be permanently set higher in some areas. That means the bar for purchasing power and real returns has been reset. Clearly, lower-yielding investments like cash and high-quality bonds have suffered. So how can you protect your future investment returns in a high inflationary environment? The popular advice is to consider real assets, and undoubtedly you've heard about them lately in the news or from the financial media. Commodities, gold, tips, real estate, and even cryptocurrencies are cited as inflation hedges. But use caution. Many of these assets have inflation hedging characteristics, but none is a true inflation hedge. In fact, many of them have gone down in value or held steady as inflation has heated up. A great example is the recent performance of Bitcoin. It's trading currently around $33,000. That's about half of where it was in November. Other alternatives like commodities and real estate can decline significantly during stock market downturns, so often they are not the hedges they are billed to be. Diversifying into alternative asset classes and away from bonds isn't necessarily a bad idea, and in fact we've done just that for many years in an attempt to address historically low interest rates. However, reacting to inflation that may or may not be a longer-term problem seems rash, particularly when the solutions are imperfect at best. There are economic experts who currently have strong opinions about inflation, like Larry Summers and Nouriel Roubini, but even they can't predict the future, so for now, we're sticking with our long-term approach of stocks for growth, high-quality and short-duration bonds for safety and liquidity, and some alternative investments to help control the risk of stocks while reaching for a little better return than bonds. It sometimes seems quaint to hold the line and diversify while tuning out the latest economic headlines, but long-term empirical data suggests that is the best approach. Thanks for watching today. Please share your questions and comments.